An efficient financial market ensures all information is disseminated and costs are attractive for both borrowers and lenders. The participants in a financial market are banks and financial institutions, large investors like mutual funds and corporate, brokers and dealers, custodians and depositories. This slide has a graphical description of the financial market. As you can see, the market comprises of both money market and securities market. Money market facilitates short-term lending and borrowing, while securities market ensures funds are available for long-term investments. Now let's discuss the banking system in financial markets. Reserve Bank of India or RBI is the apex bank. It serves as a regulator of the banking system and the monetary authority. You can browse through the main functions of RBI. We will discuss functions of RBI in detail in lesson 12. Moving to role of banks, banks ensure funds are available for capital growth by channelizing savings and making them available for credit. As you can see in this diagram, household, government and businesses deploy their savings in the banking system. These savings are made available to institutions and households as credit. Other functions of banks include facilitating transactions, offering advisory services, and access to financial products. There are 4 types of banks: commercial banks, cooperative credit institutions. RBI has recently notified a new type of bank, payments bank. They do not accept deposits greater than 1 lakh and cannot lend. And small financial banks for micro lending. Securities market provides an efficient institutional structure that provides businesses and access to funds from large number of householders and institutions. Securities market can be divided into 2 segments: primary market and secondary market. Pause and go through the salient features of these markets. We will get into detail about these interdependent segments in lesson 2. Commodities market. These markets facilitate transaction between buyer and seller of commodities. Commodities range from agricultural products to metals. Transactions can be both in cash market, also called spot market, for immediate delivery, or at a future point to hedge risks of price movement in the future. This can be facilitated by forward or futures market. Forwards are customized contracts between buyers and sellers. A futures contract, on the other hand, is exchange settled with standard terms of delivery, price, quantity, and quality of the underlying commodity. With exchange as a counterparty, both parties are assured of settlement and protected from risk of default. There are 3 exchanges for commodities in India: MCX, NCDEX, and NMCE. Clearinghouse determines and settles obligations and collects margins. Securities and Exchange Board of India, or SEBI, is the regulating authority of commodity exchanges in India. Foreign exchange market is the market for buying and selling of currency. Like commodities, currency is traded in both spot and forward markets. It is important to understand delivery and settlement in the spot market. Delivery and settlement happens in T+2 business days in the spot market. For example, if a trade happens on Monday, settlement will happen on Wednesday. If a trade happens on Friday, Saturday and Sunday being off, trade will happen on Tuesday. Currency is quoted in pairs. Let's look at this example of USD INR. If price quote is 65, it means 1 USD is equal to 65 INR. USD is called the base currency and INR is called the quoting currency. Banks provide two-way quotes and are called market makers, while merchants buy or sell on the price given by the bank and are called price takers. Like the commodities market, future transactions can be done over the counter through customized contracts or through futures contracts on future exchanges. For forward, regulator RBI requires an underlying contract which creates exposure to FX. Next section highlights the type of players in these markets: hedgers, speculators, and arbitrageurs.